couple things you can do. You can either get now a second lien loan, so a second mortgage, so you don't lose your first mortgage. Um, the rate on your first mortgage. I've done quite a bit of those lately, where let's say someone locked in 2020 and they have a rate at 3 or 3.5%, and if we were to refi the whole loan, now they're looking at 7.75 or 8%, right? Because when you refi and you cash out, that rate's always a lot higher than if you were buying. So just remember that. So you don't want to refi the whole amount. You only want to refi, do a cash out on what you would need. Let's say you needed, you bought that, and like in your scenario, the home is worth $1 million. They probably paid it off a long time ago. Now they have $1 million in equity. They don't want to sell the home, or even if they had a loan for $500,000, let's say, and they could take out another $200,000 to buy another home or help out a family member buy a home. Then we get a second lien mortgage. So yes, the rate's a little bit higher, but you're only paying that higher rate on a small amount. So in this case, you'd only pay the rate on $200,000 versus $700,000. You can do that, or you can get a home equity line of credit as well. HELOCs are different. I'm sure everybody's heard that acronym HELOC. And HELOC, it's not like a credit card anymore. It used to be where the bank or a lender would say, okay, you have a $150,000 or $200,000 line of credit, and you take it out whenever you wanted. Now the way they work is you have to take out most of the money in the HELOC immediately. So even if you didn't need the money, you're forced to take it out and keep it for a few months, so you're paying interest on it. So those are things that you have to weigh when you're getting this kind of loan. So those are things we discuss, and I discuss with my clients is, okay, let's sit down and write down really what you need, what your goals are, how we get to your goal, and then put a plan together for that makes most economic sense for you.
I see. So what a homeowner could do, you're saying, is keep their low interest first loan, and then get a second loan or get a home equity line of credit.
Correct.
Based on the equity that they have, so they keep their low interest, and then they just get maybe higher interest on the second, so they can have that money to move on to the next property and keep this one.
Right. And if they have, I just did a loan this week, actually, for a client who their home is worth, I don't know, $2 million, right? They've lived in it for 50 years. They bought it for nearly nothing 50 years ago. Now it's worth a lot. But they're equity rich. They don't have a lot of cash. It's all in the home. So they wanted to help out one of their children buy their home. So we took out a $500,000 loan against the primary residence, and that was a first lien loan. So those rates are lower. Just in this case, because the loan to value was so low, it was 25%. We got a rate at 6.5%, which is great for a cash out refi, because usually cash out refis are in the mid 7s or higher.
I see. Okay.